This is CNN Vantage Point. I'm Philip Pro, Chief Investment Strategist with CNN Wealth Management. In today's podcast, we'll provide a market review for the month of February 2023 and our current outlook. Despite ongoing recession concerns, recent economic reports indicate the U.S. economy is retaining momentum. January's Employment Situation Report, released on February 3rd, showed an astounding 517,000 jobs were created, and the unemployment rate stands at 3.4%. The ISM Services PMI Index, a measure of service sector activity, moved from contraction back to expansion. Consumer spending remains healthy, with the advanced release of the January U.S. retail sales showing a 3% month-over-month gain, noticeably above expectations for a 1.9% increase. The Federal Reserve concluded their first meeting of 2023 on February 1st with a 25 basis points increase. It indicated additional rate increases will be needed to further reduce inflation. Inflation reports released in February validated the Fed's assessment as the Consumer Price Index rose 6.4% year over year, above expectations for a 6.2% increase. Relatedly, the PCE price index rose 5.4% year over year, above expectations for a 5% increase. Inflation and economic strength contributed to sharp increases in bond yields. The 2- and 10-year U.S. Treasury yields rose 0.6% and 0.4% respectively. The expected terminal Fed funds rate rose to around 5.5%. In equities, inflation and additional rate hike concerns prevailed over positive economic news, and major equity indices declined. The U.S. dollar reversed a 4-month decline and increased 2.72%. In contrast, the Bloomberg Commodities Index declined 5%. Commodities often trade the inverse to the U.S. dollar. The persistent nature of inflation is now stoking the conversation of how high will the Fed need to raise rates. Entering the month, the consensus was 50 basis points. Now, the consensus is 75, with 25 basis point hikes in the March, May, and June meetings. This would extend the terminal rate to 5.5% and provide stiff competition to equities. The bond market reacted by yields jumping nearly 50 basis points in February, with the 10-year Treasury now hovering near 4%. Yield levels are providing attractive valuations for core fixed income. A better gauge of core fixed income is the Bloomberg Aggregate Bond Index. At the end of February, the yield on the index stood at 4.8%, which represents nearly a 0.6% increase for the month. Earnings estimates have declined, albeit at a slower pace than we anticipated. Economic data still shows a slowing environment, but equities remain resilient. We continue to believe that a downward trend is in place, but any soft landing or shallow recession has been pushed out a quarter or two. With attractive fixed income valuations, we have been adding to our core fixed income positions for those accounts with excessive cash in order to lock in rates. But with an uncertain Fed and a slowing economy, we're comfortable remaining neutral to equities with a slight defensive tilt. We made no portfolio changes in February and look to the Fed's March meeting on the 22nd for our next assessment of portfolio positioning, in the event they surprise the markets with a 50 basis point hike. We anticipate increased volatility later in March, given the uncertainty of the Fed's actions. If you would like more information about our portfolio positioning and market thoughts, please contact any of our wealth management advisors. If you like this podcast, we'd be grateful if you share it with your friends. On behalf of the entire CNN Wealth Management team, I thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.